Hello my fellow investors and welcome back to another very crazy video. Today guys, we're going to talk about something that just occurred that will have an insane impact in the markets. And also we're going to talk about the utility sector XLU and also NEE, the biggest company when it comes to XLU, because they have just completely taken a huge tumble. So with me I have obviously my friend Mike.
Hello everybody.
So we're going to talk about guys XLU, but I have to mention the big elephant in the room, which is what you're looking at the screen right now, and that is the fact that McCarthy just got taken out from the House as Speaker. So yeah, this is causing markets just completely tumble, and the reason why I'm mentioning this is because, well, Moody's says if government goes into shutdown, they will be negative for the US credit ratings. And they have what, 42 days to come up with a speaker. And if that doesn't happen, then the government will shut down, and therefore Moody's is going to bring them down. So what are your thoughts on this?
Well, Moody's is the last AAA rating, so it'll be the last holdout, let's say. Standard & Poor's was 2011, Fitch was recent, so Moody's is kind of just beyond the bandwagon. And that's not to say that even if they bring it to the precipice similar to Fitch, basically saying, well, because you guys brought it to the 2 seconds to midnight, that you're going to get a downgrade anyway. I think that hypothetically within 10 days of the deadline of the 40 days, I think that Moody's may actually downgrade it regardless of what's going on, because it means that you're like a credit junkie that is barely managing to pay their bills, and that's not deserving of a AAA rating. A AAA rating is you pay your bills early on time and there's no risk.
Right. So that is very, very interesting as to what's happening. Now we're going to cover this more when it comes to the Friday deep dive and the debate. But for now, guys, we are going to cover XLU. So we're going to be doing a technical analysis when it comes to this. So Mike, I'm going to put it to you now.
So XLU, pretty much a bloodbath. There's nothing short of a complete sell-off to describe this. And I don't know if there's any end in sight. Some of you throw down in the comment section, do you think it's a dead cat bounce, or do you think that it's going to keep going?
That's interesting. So is that it? There really is nothing else to it?
Well, there's a couple things to it. So I got this trend line plotted out from a very long time ago.
Which is the trend line? The white straight line, right? Okay.
So this goes back to 2008. A lot of things correlating to 2008, yield curve, all this other stuff. So 2008, you see how it kind of just bounces along here. COVID kind of pierced down to this level, and then you're pretty far away from it currently. But usually with this larger, if you look at COVID, how it had a massive volume spike and then kind of leveled off, we really haven't seen an equivalent volume spike. Yes, it's bigger, but this is the weekly. We still can have 1 or 2 more weeks of more selling pressure, and that could be your traditional volume capitulation. If you just look at these larger spikes that happen on here, they're pretty massive, and in comparison, you're getting up there, but you really need to see multiple weeks of that volume, and then it starts decreasing. You really don't find a bottom until you're decreasing the volume by 1 or 2 weeks, which is stuff is calming down. So this candle's still not closed. Got 2 days and 21 hours before it closes on the weekly. So you could get a reversal here. You could come right back down to this trend line, bounce around this trend line around the 52s for XLU, right down at 56. So that'd be basically probably what, like a 12%, 10% dump still. So in total, from your recent highs, that would be approximately a 24% haircut. So more severe correction / recession territory from recent highs. And then obviously going to be utilities would be in a bear market, considering from all-time highs to here at the current price, here negative 24%, and my prediction negative 30%. So there's a couple interesting things that are going on with XLU, mainly just 1, the volume. 2, you get that trend line. Me personally, I think it's a dead cat bounce, just because I really don't see the strength or the motivation. It's more of people just trying to buy the bottom because, well, you have a pretty steep discount. If you just look a couple days ago, right now you're getting a 12% discount. So risk to reward, 12% to more upside versus where you are now. A lot of people are toe dipping. So we have to see if it stops. You need a couple candles. You're not gonna, in my opinion, get the V-shaped recovery. I think you may get consolidation, then push back up. I could see that. But I think you want to see at least 1 more candle close before you start going larger in position size or even any more leveraging per se. That would be my 2 cents on the subject, but I think this is a sell the rumor, buy the news type thing, where they're selling it off on fears, and I don't really think that is justified.
Now, the main reason that I want to talk about XLU is because the biggest company when it comes to XLU, it is the company NEE, which just had one of the biggest drops I have seen to date. It's absolutely ridiculous. Now, as of today, this thing is up 1.21%. However, post-market, this thing is it's essentially zero, kind of going down. But the big drop, guys, happened. If we come over here to the monthly, take a look at this, guys. From September 22nd, well, actually, I would even argue from September 26th, this thing was 67.47. And then we just had a massive drop going down to a low of 50.49. In fact, this is a 52-week low company, or at least very close to a 52-week low. So I wanted to cover this because this is the biggest player when it comes to XLU. And the fact that this happened is interesting. Now, the reason why NEE fell, it's actually kind of weird. So if we come over here, NextEra Energy Partners sinks to nearly 7-year low after cutting growth views. Very interesting. So this is the partners, but it's the same thing when it comes to NextEra Energy, the normal company. And well, we could see that that's the reason why they fell, because they're cutting growth view. It's a utility company. I don't see how they would grow to begin with. Like, I'm not saying that there isn't growth, but I'm saying that, like, this isn't a tech company.
You guys get not you guys, but the bulls get the narrative from Powell of, well, we're expecting lower growth, and you cheer for that. But when an energy company comes out and gives you what you've been cheering for, you dump 40% from all-time highs. This is bizarre world.
And this article right here may also explain as to why today this thing actually jumped around 1%. NextEra Energy plunges despite buy rating reiterated at Goldman as drop overdone. So that's interesting. Right? That's very interesting. And by the way, it's not just NEE, it's also Southern Company, it's also Dominion, it's also a bunch of, well, pretty much the entire utility sector. But that's very interesting that, you know, over here you have a 7-year low after cutting growth, yet Goldman Sachs is like, yeah, this is way overdone. This is not worth that at all.
Well, any company in particularly, sectors are a little different just because it's a conglomeration. But when we're talking about an individual company, you know, I have to separate that from my previous comments. Anything that moves down that sharp usually has a pretty massive rebound. So those toe dippers, I think especially Goldman is toe dipping into this because they're saying, well, I'm getting from what recently was, right, just a couple days ago, I'm getting a 25% discount. Like, companies don't grow by 25%, and this thing just fell in 3 days by 25%. Risk to reward, yeah, that's like a 10-to-1 where, okay, it makes a new low, I lose 1 versus making 10 times my money. So, you know, for them, it's obvious. It's an obvious risk to reward win.
And again, this is the biggest company when it comes to the utility sectors. You guys can see right over here. So the fact that this one is the one that Goldman Sachs is just like, yeah, I don't know what you guys are doing. It's as if, like, you know, Amazon or Apple or Microsoft fell, like it's the biggest red ones in like the technology sector and the consumer cyclicals. I think that's the reason why they're buying into it. What do you think, Mike?
Well, the thing is, how do all investment hedge funds work? Sell high, buy low.
Right.
It's kind of their whole deal. They buy into weakness, sell into strength. So they're looking at this and being like, well, let's see. They didn't basically come out and get like indicted for something. They didn't come out and like, you're near where you were at COVID. Let's see what else. You went straight down on massive volume, and you're buying today with massive volume as well. So volume capitulation over ? And again, I reiterate, risk to reward.
So given all of that, we are going to do a fundamental analysis on this company. Now we're going to do this rather quick, and later we're going to do, Mike, I want you to take a look at the technicals when it comes to this as well. But let's do this really quick. We got the ticker for NEE, market cap of $107 billion with a PE of 13.07, current share price of 52.78. Now they do pay out a dividend. I'm so sorry I don't have that one, but they do pay out a dividend of 3.6%, currently 3.59, which is being 47 cents per share, a payout ratio of of almost 60%, a 5-year CAGR of 11 with 27 consecutive years of dividend payment. That's nothing small. Ex-dividend date is actually, ex-dividend date passed as of August 29th. Payout date was on September 15th, and of course they do pay their dividends quarterly. And based off of the current shares outstanding and this $1.87 in annual dividends per year, they pay out almost $4 billion. So let's take a look at some graphs, shall we? We got the net income 5 years ago of $6.64 billion to today of $8.1 billion. Now, Mike, what you're looking at this right here, this today graph, is what they have done so far. So the fact that they just said that they're cutting growth, yet they're higher than what they were 5 years ago is interesting. This is up 22%. So what would you take of this as a grade, good sir?
Considering where inflation is and that they're considering basically making a crap ton of money, to me, I don't look at it as a statistical outlier just because costs are going up. They're looking the previous year costs are going up. Energy costs and every CPI report's going up. So there's an explainable why that delta is like that. Now I have to slander them a little bit for the growth just because it's like you want to see more than one data point. One data point doesn't establish a trend. So I'm going to say like a 90 just because I want to be a little conservative on how much I'm weighing it. But overall, it's a very good chart.
All right. Taking a look now at the revenue. This one looks a little bit, actually a lot better. We got 5 years ago of $16.7 billion to 1 year ago, to today of nearly $27 billion. That is an increase of 61%. This is more precise to continuous growth, as you can see, right? The 2 years that went down was 3 years ago during COVID, and of course the following year. But then after that, you can see it is pretty much consistently increasing, taking away these 2 outlier years. So what would you say is great?
100 for me, just because I know what the 2 year, that's when inflation kind of bottomed, kicked off again, more revenue for them.
Perfect. Now let's take a look at the shares outstanding. Now, utility companies usually issue shares. So you can see right here when it comes to this one, we got 5 years ago of 1.9 billion to today of 2 billion shares. That is an increase of 5.84% on the 5 year. And from the previous year to the current year, it is an increase of 1.85%. Very consistent increase. So what would you say is a grade?
I don't like that they're issuing shares, but to your comment, this is a sector thing. Correct me if I'm wrong.
Yes.
So it's almost like you want to say like 80, you don't want to give it like the 100, the 90 because like, you know, it's expected. So it's not like bad, but it's like you don't want to sign up for it. Yeah, I would say 80 just because like it's what you're expecting. Like it's you gotta swallow the pill a little bit just because it's bad, but it's like it's not changing. That's the nice thing about it. It's like you're gonna have this is how much it's gonna increase. You can factor that in. It's stable, it's expected, it's something that can be assumed.
Assets minus liabilities. This actually isn't looking too bad. Pretty consistently, actually, it is consistently increasing year over year. Average total assets, it is 136.2 billion. Average liabilities, it is 90.5 billion. Doing this difference, we get $45.7 billion. Would you give this as a grade, good sir?
100. Just 100. Because it's the utility company, they just buy stuff.
And now, guys, with all of that said, let's take a look at the overall grade. So if we come over here, we can see that net income of 90, revenue 100, shares outstanding of 80, assets minus liabilities 100, overall grade of 92. Now, this is a lot higher than what I would have given it. I would have given the net income a little bit lower, but it would still be around the realm of maybe like 80, maybe 70 something, right? So, you know, it's a good company just from the fundamentals alone. Now, the thing is, what price we should pay for it. Now, utilities, we cannot use discounted free cash flow because they don't have CapEx. So we have to take a look at now book value per share. Now the book value is very, very easy. Mike, is assets minus liabilities divided by the current shares outstanding. That's all that is. And the book value, because you can see the current book value is $22.13. This means that the company should be worth $22.13. That's what that means, okay? This is up 24% from the past 5 years. And when it comes to the tangible book value, some people like this more because it strips away anything that's non-tangible, right? Well, this becomes $19.57, increase of 15%. So if we take a look at the price divided by these book values, we can see that, well, NEE, guys, is still expensive. Yeah, it's still expensive. You can see 2.38 for the book value and 2.7 for the tangible book value. So that's interesting because, well, even with that drop, it's still telling me that it's still very expensive. Now, I'm curious as to see what the technicals actually say when it comes to this.
So while you were doing that, I did draw 2 trend lines that I want to bring your attention to. So these trend lines are basically just pulling really long trend lines on previous bottoms over very long history. One stemming all the way back from 2011, almost 2000, all the way to 2008. Another one back in 2015, 2016, when energy kind of just had like its slump. And then meteoric rise. Yes, this is technically what you can say parabolic. But if you hypothetically say this is a parabolic move, 70% correction brings you down towards that bottom trend line there. So with NEE, you would pretty much have to continue volume capitulating through these levels. That's not to say that you don't kind of just slide down, right? You're below all the moving averages, just for everyone to see here. You're below the 200 weekly. Yeah, everyone knows my opinion about that is get out of Dodge when that happens. And if you follow that logic, well, you would have saved yourself a lot of headache. But, you know, we're not here to beat old history into the ground. You're below all the moving averages. Now, that's pretty bearish, but again, it's a utility company, and you have to look more long-term with this stuff and kind of take into account some of the microeconomics and stuff like that. Sharp move down. Usually with technicals, you say that's going to reverse once it bottoms out. How do you know it bottoms out? The volume stops going up. So don't go head first into it. But for me, I would like to see, one, how does it interact with this trend line? Do you get to that trend line, that current price at the trend line? If you assume it happens the next day or so, be $48.50 roughly. That's where you want to see, isn't it an interesting buying opportunity? Again, you got Goldman coming out that's saying, hey, you guys are overblowing this a little bit. I tend to agree with them on that, especially if you look how sharp of a bounce COVID was. Some things with COVID, you were significantly above the 200 weekly. You never actually breached below it, versus now that you breached below it, especially with like energy companies. I personally think, this is my running theory, and this is how I would trade it, is you have to be willing to go through some pain with these companies because they are used as a store of value. So when people need to move money, when institutions need to move money from one side to the next, it means one of two things is happening. That institutions are basically running to their piggy bank because their second, third, fourth, fifth piggy bank has run out of money, especially if you look at the reverse repo, bank, and short-term lending. Treasuries are driving, I think, a lot of this. I think treasuries, as you see here, when 10-year started spiking around this time, and energy companies as a whole went down. I can't really surmise where we're going with this. I want to see a couple more candles. I want to see how the volume plays out. Would I go toe dipping into this? Personally, no. But if you're thinking about it, this is not a bad place to think about it, because a 25% discount from recent highs, 40% discount from all-time highs, you start questioning, okay, at what point would you buy it from all-time highs? Now, there are many companies. I can probably pull up an example right now of 99.9% devaluation from all-time highs. That's not the largest energy capex company in the sector. So playing between, comparing an apples and oranges there. Right now, I'd be looking for first what happens at 48.50. And then secondly, probably around the $40 mark. After that, well, I think we got larger problems on our hands if we just get a straight move down, especially this being such a sharp move down. I want to see how it plays out. A bottom on this company would basically look like just consolidation, just sideways consolidation here around this price point, allowing people to accumulate shares in this area, giving them the opportunity to buy it at this level and then push it up higher. That's what I'd be looking for. How it all plays out, I have absolutely no idea. And anyone that tells you, hey, it's gonna bottom here, they're all full of crap.
I fully agree. And for me personally, I actually did start buying into utility companies. Now, not NEE, I actually bought into Southern Company. And that one I did because, well, I just wanted more shares of that one. And the yield, the dividend yield has a 4% on that one. And if we take a look at the dividend yield, or at least the amount of dividends you would get for NEE, putting in $5,725, this nets you an annual dividends, guys, of $202.85. That's a lot, right? Anything above like 180 is a lot. So 202, that's crazy. So my personal opinion when it comes to this is I suggest to, again, just a suggestion, not financial advice, it is to dollar cost average. Because at that point, if it consolidates, as Mike, you said, then you get to accumulate shares. And if it continues to drop, then that means you get to lower your cost basis some more. So this is personally what I would do. But of course, guys, please make sure to note that this is not financial advice and that every investment is the present value of all future cash flow. The calculators that you saw today when it comes to the utilities, that can be found, link is in the description below. It is available for free, just so that way you guys can make your own decisions. Now, because we had a massive drop on this, I highly suggest everybody does your own due diligence, takes a look at the earnings earnings reports and goes from there. Please do not just use what we just said as, you know, as like something to follow, because as you can clearly see, we have very differing opinions. So the reason why we do this is just so that way we can give you guys a much more wider range when it comes to your resources, right? So just keep that in mind, and that pretty much does it for this video. Y'all can follow us on the New Tech Sites, link is in the description below. So with that said, peace out, and we will see you all next time.